everybody. It's Wednesday morning. It is almost midday in the trading day here on the West Coast. Beach time, as we like to say. We got Dr. K here from London. I think in a couple of weeks I will be back in LA, right, Dr. K? And we'll probably be doing this from the beach. Maybe we'll do it live from the beach, see if my laptop will make it. But anyways, what do we got going on here? We have the model going to a cash signal. So the buy signal, previous buy signal, was a false signal. And as we know, the market will have false signals, or the model will have false signals, and you just go with your signal. So if you lose a few percent, that's what happens. And for us, that's very tolerable. We've been following the model all year long. And as of the end of September, we were able to be up about, well, exactly 56.51%. We're going to give up a few percent here on this pullback, of course. But, you know, you use the model the way you're supposed to, and I think you're fine over the intermediate to longer term. So, you know, so what's going on here is a lot of news-oriented stuff. You have potential of the Greek government dissolving or collapsing tonight on this referendum that suddenly hit the European markets overnight. And I think it's kind of interesting because you're just in this bizarre, news-oriented, QE-oriented, and influenced market that's pretty choppy up in here, and you can see that in the NASDAQ Composite Index. If you look at the index, we came up all the way through October, but towards the second half of October, it gets very choppy, and this is just continuing that pattern. But I would think that with the volume up as much as it is, the model's moved to a cash signal. We have a huge gap down on huge volume. Dr. K, what are the volume rates this morning?
Last I checked, actually, which is close to the day, we were quite pushing such high volume levels that the model was very close to actually moving from a cash to a sell signal, and that may very well happen before today's close.
Right, and we'll see what happens. So we haven't done anything ourselves. We actually came in long 25% position in the TNA, and you know, that's so we're not going hog wild. And I think we indicated in our market direction model email a few days ago that there were some considerations in terms of the bizarreness of the route, the fact that you can straight up from the bottom. But I think this pretty much negates all of that. Where we close today is another story. But where does the Fed or somebody else come in and step in and try to prop things up? Who knows? It's very tough to go short this morning when you have a gap down. Unless you came in short overnight, then you're sitting pretty. But I do think if this is going to be a breakdown that carries further and starts a new leg down, then you're really early in the game. So for myself, I don't get excited. From my own perspective as a trader, October was almost the strangest month I probably ever traded in my career. And the reason is up close to 40–50% on the short side in just a few weeks in October. From this period around about right here through the end of October. And I kept almost all of my gains on the short side while the market was doing this move back up to the upside. And that's, I gotta tell you, that's just a strange occurrence to make a bunch of money on the short side while the market is in a rally like that. Dr. K, what's your take on the general environment right now?
More chop and slop. A continuation of this volatility that began. Well, really, the volatility's been with us all year, but it became more pronounced in August, and since then the market's been up, down, so that makes for much greater risk in trading this kind of market. So as we've always advised, if you were going to buy into a stock or an ETF or short a stock, you might want to use a pyramiding style where you get your feet wet on the first position and then let that position prove itself on a price basis before you add more to your position. And this is especially true for 3 times ETFs, where they're going to be 3 times as volatile, if not more. Readers will notice that we have not been recommending the TVIX in our suggested ETFs simply because this is a very volatile environment, and TVIX is probably the most volatile ETF of them all. So if you're going to be dealing with the TVIX in your portfolio, make sure you understand how wildly volatile it can be, and then position size accordingly. So if you're a more conservative investor, you might want to only put in 5 to 10% positions of the TVIX because it's just that volatile.
Yeah, in our experiences, we went 25% long the TNA and you get tagged a little bit here, no big deal. We do get the occasional emails that are interesting to us because they are typical of why a lot of investors don't make money over the longer term. And if somebody's recently come in contact with our website and the model and have used one signal or two signals, guess what? You're probably not making any money. You're probably losing some money, but that doesn't tell you anything about the long-term potential of the model. And those of you who have been using it for the last few months or this year probably know what we're talking about. But you just have to take the market for what it is. Very news-oriented. You have MF Global going bankrupt, John Corzine's company. And we were noting this morning, I was talking with my trader, Bill Griffith, we were noting on the different news websites, if you go to CNN's website, there's no mention of MF Global because it's run by John Corzine. He's a liberal. He's a Democrat, former New Jersey governor. But you go to Fox, it's the top story. And the scandal here is that MF Global commingled funds, client funds, with firm funds and made investments in European bonds. So John Corzine, we know why he went into government because he's probably a goofball. And he's helped to take MF Global down over the last year, even though he did only come in a year ago. But that's pretty scandalous, I think. And MF Global was also a big player in the commodities arena. So I think that puts some pressure on gold, but I think gold and silver are buys on the pullbacks. Because if there is a crisis, if there is a collapse in Greece, of the Greek government, and if we start to see Spain, Italy, and Italy, as you know, Berlusconi is being very intransigent towards his European counterparts, particularly France, and they're really not getting anything settled over there. So if all that collapses, and I think you are subject to an exogenous force like a collapse that decides the issue before all the Eurocrats can all coo and say goo-goo to each other and come up with some solution, because they really haven't. They announced that they're going to, or the plan is to ramp up the EFSF to over €1 trillion in leverage, and so that's nice, but are they really doing it? What are the mechanisms? What is how are the policies going to impact that? And they really haven't gotten there. So you have the potential for the markets to decide the issue for them. And I think what you're seeing is what's going on right here. That's exactly what's happening. So based on that, the model's neutral, so you should be in cash, and that's where we are. We'll see if we get a sell signal later. But I do think you have to look at, the pullback in gold here today. Comes up, you get the buy point here, okay, and that's a pocket pivot buy point right there. You see on my charts, I use the 65-day exponential, but it's actually coming off the 10-day. But it does come above the 65-day exponential line too, and you notice that was resistance before here. On the pullback, you're finding it is getting support, but it also, the 65-day exponential also coincides with the 10-day moving average, which is the magenta or pink line, whatever you want to call it, that you see here. So really this move up followed by this pullback, and you're getting support off the lows on the nearest gold futures contract. I'm not looking at the GLD. If we look at the GLD, you can see that same situation roughly. So on this pullback, this would strike me as a viable pullback in the gold, and I tend to favor the gold here over the silver. Dr. K, any comments on the metals?
Well, I think this is a natural pullback because they are in basing patterns still. The news, of course, has pushed everything down. But it looks to me like because they're in basing patterns and because the fundamentals are still intact for a lot more quantitative easing on the way, these long-term uptrends, which began in 2001, should remain intact. There's no sign that these uptrends are going to be ending.
Right, and the long-term trend in gold, let's look at a weekly chart. I mean, from here, where's that pencil at? There he is. You go from here to here, and you've pretty much held this trend here. And if we squish it down, you're still pretty much from this breakout here in 2009. You can just connect the magic dots, and look at that. You're still holding the uptrend, the long-term uptrend. So this consolidation looks normal for gold. And like I was saying, with MF Global being a big player in the commodities biz, one of the big news stories has been how they've all been banned and have their badges and their access to the CME floor and other places shut off, basically. You kind of have to feel sorry for the guys. But there's probably some liquidation of contracts going on there. Maybe that's hit gold. There's also, you have to remember that when you get forced selling, it is going to impact almost every asset class. And one thing that was interesting yesterday is just how you got pounded in bonds. I'm sorry, how bonds suddenly were gapping up yesterday and telling you that you did have a fear trade. Meanwhile, the dollar was doing the same thing. So you were kind of getting clues yesterday on all of this. And so what you have now is forced selling, it looks like, in some of the commodities like gold. And so use that, we think, as a buy opportunity. The low of today is probably what I'd be looking for it to hold. If we're looking at the GLD, your low would be 163.61. So, Dr. K, do you think the metals are viable right here? Would you step in?
Well, I think it's advisable that if anyone wants to play the metals here, they do so in pyramid fashion like we're doing. I mean, we hold positions in gold and silver, but they're small positions, and we're ready to buy more of these positions when they prove themselves on a price basis. So I don't see anything wrong with taking a small initial position somewhere in this basing pattern. I mean, someone could have done that a couple weeks ago. But here, right here, there's nothing wrong with that, but just make sure your position size is relatively small compared to what your normal position size would be.
Right. We actually entered here, and so you move up and you come in, so we're just sitting with it. And we're just sticking to our rules. There's really nothing to get too excited about. And in general, I don't think there's too much to get excited about except watching to see how this pans out and whether we get a big break in the market. Now, you know, what's shortable? You kind of had to come in short, but I think you're playing with fire, because if you think about last Wednesday when you got the news overnight, Thursday morning you had a big gap up. A lot of those short sale names that we were looking at were gapping up a good 3-4%, so you were instantly stopped out. So what are you looking for here? Well, I'm looking for the next wave of setups, because if we are going to have a down leg in this market, okay, so let's look at the NASDAQ again. If you go back, you know, if this is your break off the peak, now you've been in this big chop zone, so the next leg would take you down from here. And what you will usually see when you have this kind of breakdown and then kind of you could call this a bearish consolidation. Right now it's becoming bullish, but if you go back and you look at other periods, you'll tend to have this kind of move into new high ground. We've had to go a little further this time, and then a breakdown can definitely occur off of this sort of situation. And if you wanted to, I guess you'd call it something of an ascending wedge, I guess, and you're failing now, and so now this is a bearish pattern, and probably could be shorted here. And like I said, we'll see, or as Dr. K said, we'll see whether we get a sell signal. But the premise here on the short side, and so what I'm looking for is I'm looking for the next setups, the next wave to go. So what would we be looking for? We'd be looking for late stage failed bases. Everybody still loves Apple, and they come and support it off the 50-day, but I'm watching this very carefully. I'm short Apple right now, actually, from around the 398, 399 level this morning on the gap down. I decided to just come in there and use the 400 level as my quick out, which is around where the 10-day is right now and the 20-day. So not necessarily a perfect stop, but if I'm going to mess with this one, I'm going to keep it on a tight stop, short fuse, whatever you want to call it. But I would watch this closely, because I think if Apple breaks down and breaks the 50-day, then the market is probably going on another leg down. And those of you who recall 2007, end of 2007, early 2008, back then Apple was flirting with the $200 price level. Just like today, it's flirting with the $400 price level. And let me see if I can get to there. Someday I will. And I think, where are we? 2008. Here we go. This is when it was trying to come up to the 200-day level, price level. And if you recall, the market topped back here in October, and it came down and it was going sideways. And as it was doing that, after breaking down and going sideways, Apple was actually continuing higher. When Apple failed at the 200-day moving average, look at how quickly it broke down. And when it finally busted, notice how it got some support here on this break. And when it finally busted, that was pretty much the end of the market. We had the market break. So kind of looking at a situation like that developing this time around. It doesn't have to develop right away. I've just been monitoring this, and we've been following this for a while. So I think as a short, I would be willing to come after Apple than I have today, but we'll see how that holds up. You can see, though, we're heading down towards Now we're holding up off the 50-day, but you can see it's kind of a reflex action off the 50-day moving average. But just watching that, so we'll see if this trade works. So far, it's, I'm making 0.7% on it, but that's neither here nor there. The key is whether it breaks, and I may end up covering. Maybe it happens later. Maybe it doesn't happen at all. But it seems to me that there are just too many things wrong out there to have any kind of a sustainable bull market that isn't driven solely by QE. So, so that's one target. Other stocks that we've looked at on the short side are starting to break down again. Amazon always comes to mind because it has broken down below the 50-day. You had a big major gap down that came on the heels of a, remember, 2 down, 2 up sell signal. So this is a sell signal here, so operating on the basis that this is actually a top, and Amazon would have to get above the 50-day moving average to disprove that to me. Then I'd be willing to look at it on hops up to the 50-day moving average. And even in here, you're only 3-4% away from the 50-day moving average, so it's not like it's out of range. But I think if this breaks down from here, and it looks like it's trying to, it could get through the 200-day moving average, and then it would be heading probably for this low. So, those are things to keep an eye on. I think big stocks that have held up well, the second leg down in a bear market is usually where you're start to see them come apart. And so that's kind of what I'm looking at. Keep in mind that's kind of the theory I'm operating off of. It's not something that's set in concrete or something that has to happen. But it's kind of how I'm looking at playing it if this market just continues to come apart. Okay. Other stocks that we've been looking at, I actually kept a short position in Cena over the weekend and then covered it on this break yesterday, which probably wasn't so smart given today's action, but hey, I'll take it. Made some money. And you're breaking down. I think it looks like you're heading for this low. So I don't know if you can short it here without risking a snapback, but you might use the 80 level. You can see Dr. K is back up. I guess he disappeared. But where do we go?
Internet had a temporary glitch about 2 minutes.
I see. Maybe so. If Europe goes under, if all of Europe collapses, is your internet still going to be okay, Dr. K?
London will be fine over here.
Okay.
Triple back.
I'll send you my USB stick, my Verizon stick that I have. Anyways, getting back to Cena, you see it's broken the 80 level. So I think that now, since this is the low of this little consolidation, I think if you wanted to try and short it here, you'd have to use 80 as your stop. And no guarantee that it won't snap back on you because we're in a bizarre market. But that's a playable one, I think, here. Baidu, last week, we thought this was more of a shortable gap here than a buyable gap. We obviously didn't put it out as one. And now you see you're getting some support here at this confluence of the 200-day and the 50-day and even the 65-day exponential with the 10-day just below. So if all these moving averages, if this breaks down from here, then you probably are going to see this thing go lower. But a lot of these are developing, so just watch the short sale setup emails. As I'm kind of going through them and culling through my screens, I'll test some things here and there and see what gets some traction. I've tried playing with Amazon, for example, and have a position short right now, but you can see that it's mid-range. It tends to want to hold up here, so we'll see if it breaks. But I think the key is really going to be whether it gets to the 200-day moving average, and then it's going to break. So if you wanted to test the position on the short side here with the idea that you're going to either use today's high or yesterday's high as a quick stop just to keep you from getting in trouble, then I think it's possible. So, and right now I'm not quite making money on my Amazon short from earlier this morning, but we'll see where it goes. I'm just kind of testing this out. So you guys will know when you see the short sale setup alerts come out. I think what we should do is we're going to answer some questions. Since things are developing here, we'll see where we go with it. And again, don't get impatient. This is a nice ugly break. You would have loved to have been short yesterday or 2 days ago if you have 20/20 hindsight, as I'm sure everybody does. But if this is going to develop into a longer downlay or greater extension to the downside, you're still early. So we're going to relax and we're going to take things as they come, test some short positions, see what happens, and see where this goes. So that's all you can do. Dr. K, a question for you. Do you suggest risking 4% on a 2x ETF and 6% on a 3x ETF when the model flashes a buy or sell signal?
Well, it depends on your risk tolerance levels. You might have a maximum loss that you want to take on your account of X%. So make sure you don't violate whatever that is. Now, keep in mind that the model's fail-safes tend to kick in within 2% of a loss on the NASDAQ composite. Now, that's during less volatile environments. What I should say is that's normal, during normal market volatility, which would apply to probably more than 90% of the time. So when we get periods like the one we're in, the volatility is greater, and so the fail-safes may not kick in until, say, 3% on the NASDAQ, or let's say, for argument's sake, 4% on the NASDAQ. Now that would translate into about a 12% downside on a 3 times ETF, or an 8% downside on a 2 times ETF. So when the volatility is unusually high, we'll make note of that in the report, so you can position size accordingly and also decide whether you want to even be dealing with a 3 times ETF in such an environment.
Yeah, I think this whole idea of percentage, like you're mixing up high-octane gas or something, it's just kind of arbitrary, Why don't you put 8.2% on a 2x ETF and 4.9% on a 3x ETF and another 5% on red 19. That'll mix it up real nice for you. What do you think, Dr. K? You like that?
That works.
You like red 19, right? Okay. But that just kind of tells you my opinion of all that kind of stuff. This kind of mixing percentages of ETFs. To me, figure out where the trend is going and then figure out how hard you want to play it. That's the way I look at it. Mixing things like you're some sort of a chemist, which Dr. K is, isn't really my style. Is it yours, Dr. K?
Sorry, you went out there for a second. One more time. Hello?
Are you really into this concept of mixing percentages of ETFs?
Everyone's got to find their style. I personally like to utilize 1 or 2 ETFs and keep it clean, keep it simple, knowing that there's a high level of correlation between ETFs, and especially if you're dealing within a family. If you're going to deal with, say, the family of Russell 2000 ETFs, just deal with one of them. Why deal with more than one?
Exactly. I agree.
But you might want to mix an ETF with, you might want to have some exposure to the Russell 2000 and then also the financial ETF like FAS, which is 3 times if you believe that the financials are going to outperform or underperform, which in that case would be the FAZ.
Right. Dr. K, what do you think of Bank of Japan intervening to devalue the yen? Is this competitive devaluation since they are fed up with our QE? I don't know, have you been calling your Japanese family members?
Well, the yen's been so strong. I mean, it hurts exports, and it's been unusually strong. I mean, look at what Switzerland had to do. They had to intervene because the Swiss franc was getting way ahead of itself. And Japan's got a lot of problems. It's got a lot more problems than its currency. I mean, the government has been not doing its part in terms of appropriating right policies so that businesses can thrive there, which is why we have 2 lost decades in Japan. The first decade being from 1990 to 2000. So until those policies get cleaned up and make it better for businesses to thrive, and especially new young companies, Japan is going to probably remain stuck in this fairly difficult and economic environment, which is quite the understatement there, because it's been very tough for 20 years. And I would also add that the Japanese Nikkei index is it's trading roughly 75% under its peak price of 1990, and this is 20 years later. So something clearly is not right with economic policy there.
Okay, here's a question. What's your view on the dollar, and will it decouple from the price action of the markets and metals? They seem to have been moving inversely. My answer to that is, why do I need to care? Dr. K, what's your view?
It's not going to help me make money in the market, so I don't really
so
pay too much
where
attention.
the dollar is going doesn't really matter. So we're focused on what gold and silver are doing. And they may have movements independent of the dollar, and we have no way of telling when they're going to decouple, because I pawned my I pawned my crystal ball off for a silver Stratocaster, which is as good as predicting things as my crystal ball. But we don't know. But we just focus on what gold and silver are doing. So, and there's no difference. Someone is asking whether they should buy the AGQ here or the SLV, or whether they should buy the DGP or the GLD. The question is posed in a way that seems to imply that one of these is better and that we know and that we can tell you. They're all based on the price movement of gold. So obviously it's simply a matter whether you're going to buy this or whether you're going to buy that. I actually, like I said, I prefer the gold over the silver. So whether you're going to buy this, the GLD versus the GGP, is simply a function of how much risk do you want to take. You know, if you buy 10% of the AGQ, I'm sorry, 10% of the DGP, it's like buying 20% of the GLD. So it's all simply a matter of how heavy do you want to go in and how much risk are you ready to take. When Dr. K talks about pyramiding into ETFs, is it the same pyramiding strategy that the investor dude used with silver earlier this year? Not necessarily. That's not silver dude, that's portfolio simulator dude, who, by the way, is still not doing anything, and he doesn't need to. He's feeling pretty good. His blood pressure staying low, and you know, you're trying to make long money on the long side using our methodology, using breakouts and whatnot, hasn't been all that simple. So, but no, in that case we use a specific pyramiding strategy just to illustrate that pyramiding strategies. There's nothing black and white. There's nothing 100% flawless about any particular pyramiding strategy. It's mostly a function of how you want to handle pyramiding your position. You know, I tend to like to pyramid on pullbacks following strength. Dr. K likes to pyramid on strength. So there's no one-size-fits-all technique for pyramiding. So, you know, people always ask, like, there's some magic formula, and we all kind of use our own methods based on our own risk tolerance and the way we like to play our position sizes as well. You know, when you're as aggressive as I am, you're often better off using a little bit of weakness to buy, because it'll all come in real aggressive, and if you get a snapback, I'll get yanked out pretty quick. So, any thoughts on CRM? I don't know. It's a high volume breakout today, so looks like it's breaking down below the 200-day moving average. So, you know, the pattern, if you look at the pattern, this could be one that's developing. Here's a late stage failed base. Okay, now you're breaking down. You're below the 200-day. You're hanging on top of the 50-day. Maybe a rally back up, or if it breaks down, you could short it. But there's a bunch of these that I'm looking at, and I'll have a better idea of what I want to do as I get there. But right now, I got short positions in Amazon and Apple, and so now it looks like the Amazon is starting to work as I'm watching these things trade. So we'll see where this goes. You know, I may end up losing money today. Who knows? Like in last week, rather, I told you guys, you know, I was heavy short and making money that day, and by the end of the day, not too long after the webinar, as I said, I could be covering my shorts in 10 minutes and an hour, you know, at the bell. I don't know. And of course, I was turning with the market as it found support later in the day last Wednesday and covered all my shorts. So didn't get caught on the short side on Thursday when you had the big gap up. Doesn't mean that you necessarily can avoid something like that, but if you get stopped out, you get stopped out, and you wait for the next opportunity, because when it comes, the window will open wide and you make a lot of money very quickly. So, and you only need one or two stocks. So you want to be patient, you want to pick the right ones. The reason I was able to be up in October when the market was rallying is because I was short mostly Green Mountain Coffee. And that worked pretty well. And then, you know, I was kind of playing these positions over here on these jerk arounds on Win and Baidu and everything, you know. But net, if these make you a couple of bucks one way, you might lose a couple of bucks the other way. And so there's no real breakdown. It was all GMCR really over the last month. So the point here is you just wait for those stocks when they pop up, for when the window opens wide, and that's what we're going to be focused on here. So somebody says Baidu looks like a tri-star candlestick pattern, right? I have no idea. I don't have candlesticks up right now. Now, LNKD, obviously, that was a pocket pivot with the idea that it should hold. You can either use a 10-day for a tight stop, or you can use one of these. Dr. K, what were you using on this? Because there's actually 1-2 pocket pivots over the last week or so. How would you handle this on a stop?
Right. Well, there's a couple of ways. Essentially, you've got the classic way of doing it, which is using the 10-day moving average, a violation of that. That might be, if that exceeds, say, 8%, then you're probably going to be using something else. But in this case, it's probably about, what is that? About violation of the 10-day, you know, on average might be down around the low 80s.
Right.
So, that's going to be close to that 8% maximum. The other way to do it is we're in the model's in a cash position right now, and it might switch to a sell. It hasn't yet, so we shouldn't be jumping forward. But in weaker market environments or volatile ones like the one we're in, one other strategy is just to get rid of your position or sell half of it if the stock sinks back into its base, which is what it's done now.
Yeah. I had a little position I bought on this pocket pivot, and I just unloaded yesterday because of the market. I just didn't like it. What factors are you currently using to hold a position overnight? Is that long or short? If it's working, I'll stay with the position usually. And held LinkedIn over the weekend, and it didn't work. It gapped down yesterday, but it wasn't a big position. 10% position isn't going to hurt me much if they gap down 5%. So, but somebody says, with the bad news yesterday, should I have overridden the buy signal and sold my TNA? I would say no. You just go, not if you're planning to use the model as it's intended to be used. So, on a pocket pivot, where would you normally set your stop at? Well, we just discussed that with LinkedIn. You have a variety of choices. You could use the low of the pocket pivot day. You could just, say, in my view, if you have this kind of pocket pivot move up to the 50-day here, and you have some good volume. You haven't had a lot of selling volume in LinkedIn. And when the market came down and tested the early August lows in early October, you didn't have heavy selling on LinkedIn. So you've had some good upside volume. For all you know, the stock is just continuing to build a base in here, and really that seems to be the case. My view is that given the way the market indexes are acting, I don't need to be long anything here, and I was just taking a small position. The thing with a follow-through day in the market when it comes to individual stocks is there's no reason to have to go run right in and plow into every stock you see breaking out. A lot of times I'll take 2 or 3 test positions, like I had some Visa, I had some Lulu, I had some LinkedIn, and I don't take huge positions in them. I just take some, 10, 15, 20% positions. They're not that big. And if they don't confirm my initial view by continuing higher or reinforcing my buy decision, I'll generally just back away from them. And yesterday's action was the reason to back away, I think, from stocks. If you're playing the model as it's intended to be played, then or intended to be used, rather, then I don't think you sell your TNA unless you really feel like you need to. There's nothing wrong with being discretionary on your own part if that's all the risk you're willing to take. One big down day in the market's enough to push you out of your TNA. If that's what you have in your mind as the maximum risk that you want to deal with, because obviously if you still had TNA this morning, you didn't want to be dealing with the gap down. I mean, we had TNA this morning going into the open. We knew the market was going to gap down, and we knew we were going to get stopped out. Big deal. That's just the way we work it. And you don't have to get excited about it. You don't have to get upset about it. You don't have to feel down or feel like you should have done this or should have bailed out. That's all just silly. You have to lose to win. End of story. And if you're not willing to do that, you shouldn't be in the market. So, coming soon, Euro Yen. Matt said sorry. I don't know what for. Never say you're sorry. I never do. I just like being arrogant. On pyramiding on ETFs, how do you suggest? Well, we talked about that one. Why DGP over UGL? Why? Yeah, the DGP is UGL. Notice it trades about 500,000 shares a day on average. DGP trades 1.2 million, so more liquid. That's why. I mean, you could use either one. So. Someone says, very helpful to know you focus on GMCR to make a bulk of profits. Yes, and I want you guys to all understand that you don't, one day, that's why somebody else can, do you hold shorts overnight? Well, you can, but you might get subject to a day like Thursday morning last week, or you might get a day like today. You get a big gap up against you or a big gap down in your favor. Well, the way I look at it is one day doesn't matter to me, okay? I'm not interested in trading. If I'm going to make big money on the short side, it's usually at least a two-week affair, and that's kind of what Green Mountain was. And I'm not worried about the first day down. If I can get in here, I'm going to get the bulk of this move and make a lot of money, especially if I'm using as much leverage as I like to use on the short side. So it's not all about what happens in one day. Trends take a little bit of time to develop. Once they do, a body in motion tends to remain a body in motion, and the trend will stay in your favor. If the trade is going to work for you. Sometimes they snap against you, you get stopped out, okay. But all you need is one of these. So I do want to emphasize that what we're doing right now, or at least what I'm doing on the short side, I'm trying to isolate situations where they might become playable, and part of that is done by testing positions. I'm a visceral trader. I need to actually feel the thing and actually have money in it. I can't paper trade. I think paper trading, for the most part, while it's a good way to understand the basic mechanics of how to deal with entering trades and setting stops and whatnot, I don't think the real test of anyone's mettle occurs until you're using real money. Okay, so I always have to have a stake, otherwise I'm not getting the right signal. I'm a visceral person. I don't know where that comes from. I'm touchy-feely, so, or punchy, sluggy, as some people might say. I like to bat things around, or let them bat me around and get a feel for it that way. But in any case, that's where I'm at right now on the short side. So we'll see where things go. We'll answer some questions about some stocks here. Herbalife. Did I do that right? HLF. There's my dyslexia again. Okay. Breakout that failed. If you're, in my view, if you bought the breakout, I would just be selling. If something breaks out and it doesn't hold up and breaks down like that, I'm gone. I don't mess with it. If you want to try and stay with the 7-8%, whatever it is, I think it's already down more than that in the buy point, which I guess would be around 60. So you're trading, you're close. So, stick to your stops if you have a stop on it. But my view is once that thing broke 60, I'd probably be gone. Yeah, and somebody says, very helpful to know you sold to LNKD because you did not like the market. Remember, sell down to the sleeping point. If you don't like the way something's acting, if you have something in mind in terms of how the trade should be working for you and it's not happening, just back away. That's the market is a feedback system. I use it that way. If I'm going to play LinkedIn, okay, I'm taking the same approach on the long side. I only need 1 or 2 stocks to make a ton of money in the market. In 2004, you had a follow-through day in August of 2004 in the market. When was I buying Apple hand over fist? 500-something thousand shares long Apple in October of 2004, 3 months after the follow-through day. Okay, so just because you get a follow-through day in the market doesn't mean you have to pile in the stocks so that your opportunities are all going to pop up in a window of 1 day or 1 hour or 10 minutes. It's going to take some time. So my view is, if I'm playing LinkedIn, and I'll just keep typing it in over and over again here, I want to see a move. So when that happens, it's going to happen at some point. I want to be there when it happens, but I'm willing to come in and back away. I bought and sold Apple many times between August of 2004 and October of 2004 before I had that big move at the end of 2004, and I made I forget what I was up that year, 93% or something like that. But so you don't have to rush in. Your opportunities will come when they come. Wait for them and understand how to recognize them. And part of it, being able to recognize them means getting kicked a couple of times on some things that don't work. Somebody says 10 to 15% in each name or 15 to 20% total. Well, the way I operate, it can be 10 to 15% in each name. Sometimes I go 100% in, sometimes 200% in, and that's how I test the position. When I talk about 10, 20%, I'm just trying to keep it to a level that some of you can understand, because I don't think people can understand the maniac mentality, or the maniacal mentality that goes with taking a 200% short position and just be considering to be testing it out. I believe you have a shorting account. No, I have one account that is my mad account that I go nuts on. So, and I have a couple other accounts that don't. Where was your stop on TNA? Well, the stop was not on TNA. The stop was on the market moving to a cash signal. And when I talk about a 10% position, I'm talking about 10% of net equity. I only stay 200 400% short intraday. That's correct, because I'm using day trading buying power. And by the close, I have to scale back. And usually it's just a matter of lopping everything down to a position size that I can carry overnight without getting margin call. As a strategy, do either of you allocate a percentage to the MDM and the rest for trading individual stocks? Dr. K and I manage our retirement money jointly. We run it together in a single account, and we use the market direction model to do that. That's kind of our slow money. That's up, and that's the only money that we really have official results for. And that was up 56.51% as of the end of September. So we're going to be down a few percent, obviously, given the action over the last couple of days, but that's not a problem. I just have different accounts for doing different strategies, just to keep them separated. There's nothing magical about it. Somebody says, I think this is a good point that they're making here. When you have a stock that tries to break out and fails, if you stick to your stops, don't get fancy. And for Illumina, I bought this pocket pivot, one of these in here somewhere, and it started to move up, looked okay, and then as soon as it started to break down, I'm gone. And of course, if you hesitate a few days or a few weeks, couple of weeks, you're done. And so once they fail, I'm gone. TGI, Triumph, leading stock and leading industry down 9%. No idea and don't really care. What's your favorite Halloween candy? Well, I don't know if any of you are hearing me, but I'm eating some peanut M&Ms, and Reese's Cups are always big for me. Dr. K, do you have any favorite Halloween candy?
I would say $100,000 bar, but given where the direction of the dollar is headed, I'm not sure if that's the best one.
I actually saw a kid came up to the door last night dressed up, and they did a great job. Actually made their own costume. They came up as a giant Nestle's Crunch bar, and I told them I couldn't give them any candy because I don't promote cannibalism. But I was wearing an Obama mask, so I was checking out each of the kids' bags of candy, and any kid who had too much candy in their bag, in my view, I took the candy out of their bag and gave it to the other kids who didn't have as much candy in their bag. I didn't care if that kid had been out an hour longer trick-or-treating. He's an idiot for working hard trying to get candy because clearly he's just exploiting those other kids who were out there later than he was and didn't trick-or-treat as long. So, but, well, it's the same logic, isn't it? Can you show us an example of a pocket pivot that traded textbook? Oh, they're all over the place, This is my favorite one from the last year, and that was this pocket pivot. Look at that. Beautiful. Runs up, holds tight the next day, and it's off and running. You could have played that move and made a fair bit of money on that one. Here's another one right here. You had a pocket pivot here. It moves up, pulls back, holds the 10-day moving average. Another pocket pivot here. Holds tight the next day. Boom, it's gone. Those are textbook. I wish I could trade bravely like you. It's not so much bravery as it is just being crazy. But I do allocate my money, okay? I don't run all of my money one particular way and all in high-risk fashion, Like the fund I was running that got hit on the short side and lost a fair bit of money, that was running a very, very aggressive shorting strategy, and that's usually how I get hit. But I didn't have all my money in that fund. I had my money spread around, and anybody who was in that fund was stupid if they just thought that they were going to put all their money into that fund. I was going to make them 11,000% without having a normal potential drawdown of 40, 50, or 60% like I've had many times before. So it's all about, for me, I run different strategies. It's just kind of allocating and how aggressive do I want to run my money overall and handle my wealth, so.
Yeah, and that's actually why, with running the current fund we run, I mean, we're extraordinarily, let's just say we're very diligent. We do more than our share of due diligence to make sure anyone who comes into our fund understands what the risks are, and also we don't want someone putting all their money into our fund. We're much more comfortable knowing that someone, first of all, understands what the volatility is and would maybe allocate 10 to 20% of their assets into our fund.
Right. So I think
an issue, and that money is going to stay there probably for the lifetime of the fund, as opposed to back. You get investors who will just nod their head. They say they understand, and they'll even tell you, well, this is not a big part of my net worth. Well, hopefully that's all true, because if it's not, it'll become very apparent.
Right. I think somebody sums this up really well. And I like this. Strategy allocation is better than asset allocation. And I believe that's true, yes. Somebody says, your candy redistribution plan sounds very similar to someone in Washington. Well, that's why I was wearing the Obama mask, okay. Well, we can't talk about the fund really in any detail. So we're just talking about our experiences running hedge funds. And you run aggressive strategies, so. Is it the same reason why O'Neill allocates his firm capital to 10, 15 portfolio managers instead of running it all himself? Back when I ran money for Bill O'Neill, I posed that very question to him. I said, Bill, and that was after the year that Dr. K and I were up over 500% and beat the whole group. I said to Bill, why do you have 10 of us running money? Why don't you just give it all to me and Chris? And his point was that he diversified among managers because he knows that all of us were actually different, he said, Some of us were more aggressive than others. Some of us would use margin as quickly as possible, like me, and some would be a little more cautious, and at some points never be on margin. And so he thought, he knew that using our strategy, and you got to remember that O'Neill himself ran a fund from I think 67 or 68 to the early 70s, and it was down, total return over 5 years or 6 years was like minus 52%. So he knows a manager using our methods can get hit, even on the long side. I mean, the short side's even worse, but he knew that, and so he allocated to 10 different guys and gals in-house, and that did actually help to diversify some of that. So in a sense, that was strategy allocation, manager allocation, because each manager, maybe you call it a psychological allocation, because you're using different managers, different psychologies. Bill O'Neill once told me that Lee and I were similar in the sense that we're plungers. Lee will get very aggressive. I don't know what he's doing now. I haven't talked to him for years since I was at O'Neill, but that's what Bill used to tell me. But Bill's very aggressive that way too. We're plungers, basically. Come in, do a couple of names. I think part of that's happened because when Qualcomm was having its big run, Lee was long like 500,000 shares of that thing, and he was going for it, and he made a lot of money on that. Let me tell you. The market direction model, yeah, it is our conservative strategy, yes. Lee is still working for O'Neill. Lee is very smart because he avoids getting involved in any of the workshops, in any of the ancillary stuff that goes on. All he does is run money, but he's been there the longest. I think he's earned his place, and the guy is a hell of a trader. He won the U.S. Investing Championship in '94. In 1994, that was basically a big, choppy, sideways bear market, and he was up 230-something%. So, he knows what he's doing. And the other thing about Lee is that
did very well that year, and that's what did it for him.
What's that?
He pyramided very well with Sen.
Printronix was another one Lee played, he told me, during that time. But,
right.
And the other thing with Lee is he knew after March of 2000, he never came back into the market. I think he was out for 2 whole years. He didn't bother with any of it. And I think that, that's the same way to live. So he's a great trader, one of the best I met at O'Neill.
Yeah, I would second that. I'm
assuming that he's still doing fine. He'll have his rough patches like everybody else, but when the money's there to be made, he knows how to make it like anybody. So.
Well, yeah, he did have a rough patch, but we won't go into that. But he recovered very nicely as well.
Yeah, but it was minor. Relative to how much he makes on the upside. Give me a break.
Well, exactly. I mean, if someone only examined that one window, though, they would say he's the worst trader in the world because his drawdown was so big.
Right, but they would put up a website about it.
Then, yeah.
Yeah, we know that. Anyways, all right. Less whining here. Okay. So anyways.
One question here.
Going through the questions, what am I going to leave you guys with? Here's what we think today. MF Global is a big player in commodities, probably forced selling in gold and precious metals. We like gold better than silver. We have a position we bought on the pocket pivot, and we'll just see where it goes. Doesn't mean it can't fail and we get stopped out, but that's kind of what we're looking at. Messing around with Apple here as it flirts with that 50-day moving average. I think it's 393.01. So I'm watching that. I'm watching that today. We'll see how it goes. We may not have enough volume on it. Amazon, I think, needs to be watched as well because there's a premise here, okay? And the premise is you're 2 down, 2 up. That's a sell signal. Amazon's had a nice big run. You can see this off the 2009 lows, or actually the 2008 lows for Amazon. But this could be a sell signal. So on this basis, as long as it stays below the 50-day moving average here, on this sell signal, I think we got a little more weight behind us in terms of evidence to be short an Amazon position or test an Amazon position on the short side, particularly if it busts the 200-day moving average. And probably a better chance of success than we had here because back here you didn't really have the sell signal. You're down 1, 2, 3, 4, 5 weeks and then 2 weeks to new highs. That's less of a sell signal. Here you're down 1, 2, 3, and then you're up 1, 2, 3, 4. Getting closer, but this is almost too textbook to pass by. So on that premise, that's our theory, okay? And then I showed you guys what I'm looking at on Apple, and that's using the 2007, late 2007 into January 2008 precedent when the market started a new leg down in the 2007 to 2009 bear market. It started a new leg down in early January, and that leg down was led by Apple breaking down. Right here. Okay, so this is early 2008, and so you had the market at that time. We'll go to 2007. What I'm talking about is that, see, here's the initial breakdown. This is a weekly chart of the NASDAQ. Here's the initial breakdown. Market went sideways, and it started the new leg down when Apple broke down. So I'm kind of trading this on that premise and on that precedent. It may not pan out. That's fine. But I think if it works, it could work pretty nicely. So, you know, we're looking at what's going on today in the NASDAQ. You have one leg down, and then you have this big, ugly, choppy to slightly up pattern. So we'll see if it breaks down. But if it does, you know, you're probably heading for the lows again. So stay tuned. Any potential for go-to-meeting updates? So there's always potential for that if we think we see something significant. So, Dr. K, is there a 1x short ETF on the VIX?
Yeah, it's called XIV. XIV is the 1 times inverse of the VIX.
XIV. Whoops, not XOV, but XIV. So
we recommend that if someone wants to play the VIX in tune with the model and they can't get the borrow on TVIX, which I've heard from a number of people they can't get the borrow on that, then you're better off just buying twice the position size you would have shorted buying the TVIX with the XIV, since it's 1 times.
Okay, some other stocks to keep an eye on. When does Priceline come out with earnings? Thursday? Is that right?
Priceline.
Anybody know for sure? Let's see. No, it's next week, it looks like. So one to keep an eye on. If you had a downside gap, maybe that would be shortable. But it looks like it's breaking down today. I think you're running slightly ahead on the volume this morning. It's one big leader to keep an eye on. GMCR, what do I think here? I think, you know, it's played out for now. You pulled down, you're retesting. It got some support. I'd still love to short this thing on a rally up into the 200-day if that occurred. And for now, this may take some time, maybe till earnings, I think, which come out in a couple of weeks. So I don't really think there's much left in there. And as far as the Chinese internets go, I think they're still in play. Baidu trying to hold the 50-day. Seen the weaker of the two, and I told you could short this using 80 as your stop, and with the idea that it's heading for 65. Sohu's another one. They came out with earnings yesterday, and you see how you're rallying up into the 10-day. Now the potential is that you found some support here. You're going to hit the 10-day here and roll over. So you could initiate a trade here using the high of today at 59.73 as a stop, with the idea that you're going to head for this low eventually. Or you could wait for a rally up to the 50-day, but I think you already had that. So these may come into play to the downside if the market continues to head lower. So I think there's a reasonable shot today given the weakness in the market. But keep in mind you're in a news-oriented environment, and you could have something tomorrow where the Greeks decide that the referendum, they're not going to have a referendum, and they're all going to love the French, and everybody's going to coup at each other, and the market jacks up on a gap up. So, you know, it's still tricky. I think the best thing to do is wait for a sell signal and then use the ETFs to go that way, or try some of these the Apple, the Amazon ideas, or the Senior Sohu ideas here that I'm showing you to test the short side. But, you know, scale your positions properly. And I think that's all we have to say for now, right?
One more question here was ISRG and VIIB. Both had gap ups on good earnings news. They're both still looking good. They're both medical related stocks, and both of those industry groups are doing very well. So you know, these are the types of stocks that can sometimes buck a downtrend in the market because they are medical related.
One thing though, I noticed Biogen is undercutting the low of the gap up day right now. So I don't know if there's
it's just undercutting by a hair. So if you bought the gap up, I wouldn't be selling right here. In other words, allow for some porosity, allow some movement under the low of that gap up point, especially in a market like today where it's holding pretty strongly, all things considered. But that said, if it goes much lower than where it's at right now, you might want to take some or all of your position off the table.
Yeah, Q-Core, same situation. It's holding up. So, you know, iSurge, Q-Core holding up fine. Biogen roughly holding up. So if you want to try and hang with these, it looks like you can. Visa, that's just breaking down. So that's a fail. To me, this pocket pivot should have held. Should have held the 10-day. And as far as I was concerned, I actually owned this yesterday, and it was breaking out. And you have these ants, these black triangles, which occur when the stock is up 12 out of 15 days in a row or better, showing power. And that should be following through here as it's coming out. And instead, it fails. So once yesterday it starts to fail, I'm just gone. So that looks like garbage now to me. What was the other one we're looking at? Lulu was another pocket pivot, and you can see that's failed. Okay. So a lot of times if I'm buying a pocket pivot and it's a gap up the low, the gap up might be my stop. Yesterday for me it was a higher volume reversal and the action of the market that just pushed me out. Like I said, I'm looking for a big, fat, juicy pitch coming down the middle of the plate. That's what I'm looking for, and you have plenty of time to wait for one of those to show up. Movements of 1 or 2 days in the market, while they can be pretty big, like you've seen the last couple of days, and it would look good if you were, long the TZA or some 3x inverse ETF. Yeah, but it's only 2 days, so you're going to make big money on a trend, and all you need is 1 or 2 vehicles. So we're kind of hanging out. Maybe it turns out to be Apple. Maybe it turns out to be Amazon. Maybe it turns out to be Cena or Baidu. Maybe it's not any of those, and it's another one. So we'll find out. Anyway, stay tuned, and we'll see where we go with the market direction model. So thanks for listening, everybody. If you have any further questions, just send them into info. Is it info@virtueofselfisheinvesting.com, Dr. K, or is it subscriber at?
Either way, we will get the question.
Yeah. So all right, everyone. Thanks for listening, and we'll catch you guys later. Good luck today. Take care.
Take care. Bye bye.